All right, let's settle one of the biggest debates in investing once and for all. Real estate or stocks? Which one is actually going to make you richer? Today we're skipping the opinions, we're just going to do the math. Real numbers, real scenarios. And by the end of this, you'll have a much clearer idea of where your money can work the hardest for you. So let's get right to it with a really specific question. Imagine this, you have $50,000, cash, ready to invest right now, and you're not going to touch it for 20 years. Which path, which decision is going to lead to more wealth down the road? So here's our setup. It's pretty simple. One pot of money, a 20-year timeline, and two very different paths. Let's start the clock and see how this whole thing plays out. Okay, first up, real estate. Now, the big advantage here, the sort of superpower of real estate, is a financial tool called leverage. It basically lets you control a much bigger asset than your initial investment would suggest. So, with that 50 grand, you make a 20% down payment on a $250,000 rental property. The bank covers the rest. You've got a mortgage payment of around $1,300 a month, and just like that, you are in control of a $250,000 asset. And here is where the magic really happens. You rent the property out, and your tenant's monthly rent check covers that mortgage. So think about it. Someone else is paying off your debt, while the entire $250,000 property is going up in value. Not just the $50,000 you put in. That's leverage. So let's hit the fast forward button. Using a pretty standard historical appreciation rate of 4% a year, that property could be worth over $500,000 after 20 years. And all that time, your tenant has been chipping away at your loan balance, month after month. So, what's the bottom line? After 2 decades, your initial $50,000 has blossomed into nearly $500,000 in equity. I mean, that is an incredibly powerful outcome, and that's the number for the stock market to beat. All right, now for option number 2, the stock market. This path is all about one thing, simplicity, and the quiet but unbelievably mighty force of compound interest. So the setup here is way simpler. You take that same $50,000 and you invest it all at once into an S&P 500 index fund. That just means you own a tiny little piece of the 500 biggest companies in the US. For our math, we'll use its historical average return, which is about 10% per year. And this quote right here, it really captures the difference in lifestyle, doesn't it? With stocks, your money just sits there, working for you, compounding quietly while you sleep. You don't have to fix a single leaky faucet to earn that return. It is completely 100% passive. So what happens after 20 years of your money compounding away without you lifting a finger? Well, your initial $50,000 grows into about $336,000. A fantastic return, especially when you remember it required zero active work. Now, putting these two side by side, it looks like a clear knockout victory for real estate, right? I mean, almost 500 grand versus about 336. But before you run off and call a realtor, we need to slow down, because this simple comparison is actually incredibly misleading. See, the numbers we just looked at don't account for the real-world stuff, the factors that can totally change your actual take-home returns. And this is where the decision gets a whole lot more interesting. Okay, let's break this down. First, taxes. In real estate, your rental income gets taxed at your high ordinary income rate. Long-term stock gains, taxed at a much lower rate. Then there's time. Owning a rental is basically a part-time job. Stocks require nothing after you buy them. Then you've got risk. With real estate, you're all in on one property in one market. That S&P 500 fund, you're instantly spread across 500 companies. And finally, liquidity. You can sell stocks and get cash in a couple of days. Selling a house can take months. So, here's the crucial point. There isn't one universally better investment. The real question is about finding the right tool for your specific situation, for your personality, and for your financial goals. So the choice becomes pretty clear. If you have the capital, you've got the patience, and you don't mind the hands-on work of being a landlord, then yeah, real estate's leverage can build wealth faster. But if you value a simple, liquid, hands-off approach, stocks win that contest every single time. And check this out. This is an absolutely incredible statistic that highlights the long-term reliability of the stock market. Every single 20-year stretch, even the ones that included historic crashes, has ended in positive territory. That kind of consistency is just extraordinarily rare in the world of investing. But here's the actual strategy used by so many successful investors. They don't choose one over the other. They do both. They start by building a strong, passive foundation in the stock market, usually in tax-advantaged accounts like a 401k or a Roth IRA. Then, once that base is secure, they start to layer in real estate to multiply their wealth. And this brings us to what might be the most important takeaway of this whole thing. A rental property that's managed badly will lose to a stock portfolio you just leave alone. And a stock portfolio you panic sell will lose to almost any rental. Your behavior, your ability to stay consistent, is more important than the asset you choose.
So I'll leave you with this question. Now that you've seen the math, the hidden trade-offs, and the real-world commitments, which path is the right one for you? It's not about which one wins on a spreadsheet. It's about which one you can actually stick with for the long haul. Which strategy truly fits your life?